Wednesday, September 10th, 12:50 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. We're going to discuss options on the equity market. The word equity is another name for the stock market. Options is a form of derivative. Another form of derivative are insurance policies, health insurance, auto insurance, home insurance. Yep. The futures markets also are derivatives. But specifically, this video is going to be going over derivatives that are the options on the stocks. That being said, not all stocks have options listed. Choice of the company. Sometimes a company could be on the stock market for years and all of a sudden make a decision they want to have options on them. Again, options are a form of a derivative. The primary product is the stock, and the option contracts are the derivative on the stock. Auto insurance, you have the automobile, the physical product, and then you have the insurance policy on it, the derivative. The derivative being the option, derivative being the assurance. There's a contract between the two parties. Example, you might have it where they're on a contract for 1 year and making monthly payments on a fixed dollar amount that you both agree on. Or maybe you're going to pay 6 months ahead and get a discount, or pay a year ahead and get a discount, maybe. The policy spells out, again, what you're required to pay, for what duration. You're paying for the derivatives, and the other party is receiving the payments, the premiums. The payments are the premiums. That being said, there's risk on both ends. And if you end the agreement early with the options, you can get money back. If you end the agreement early with the insurance company that you paid up front, you're going to get the difference back. So the party that sold it to you, they're not going to get the full amount they expected if you're not going to stay with the agreement. It might be 1 year or 6 months. The payments are the premium. So there's two parties involved. The one buying it is paying the premium. The one selling it to you, the insurance agent, the insurance broker, is collecting the premium. How's that price figured out? Several variables: the make, model of the car, the risk of the person, the location you'll be using the vehicle, and what it's used for. So let's go to the options market. And I select the stock here in the top left. It's a stock ETF. The symbol is Uniform November Golf, UNG. It's a stock ETF. What kind of stock ETF is it? It's a commodity stock ETF. It's not a high-tech company. What kind of category in the commodities? It's in the energy category. Commodities have several categories, energy being one, metals being another, food being another, and other ones. So again, this is a stock ETF on the commodities market. It trades in the energy, and this is natural gas. So the company that created the stock ETF to get listed on the stock exchange, they are managing the derivatives in the futures markets. Yeah. So again, there's another exchange called the futures markets, and there's different futures markets that compete against each other. And one of the financial instruments in the futures market are commodities. So instead of if you don't want to go trading the commodity markets, trading futures, trading energy, trading natural gas, well, this company does it for you. If you're bullish, bearish, you can use this underlying stock ETF. Uniform November Golf. The price, last trade, $12.94. Here, it's level 1. Shows the last price, $12.94. The net change, the bid and the ask. The bid, $12.93. The ask, $12.94. That's 1 penny wide. Very nice. That is very nice. And here's the volume for the day. Yep, 12:55 p.m. right now. That's the volume, 3,758,000. And the volume just went higher. There's more trades. And the opening price, the high, low. So this is considered what's level one. And bid ask. If you want to buy the stock, it typically gets filled at the ask. And when you want to close the position, it typically gets filled at the bid. So if you're bullish, anticipating the stock to go higher, again, if you anticipate the stock go higher, that's referred to bullish. It's also referred to long. Typically, the order gets filled at the ask. Inverse, if you anticipate prices to go lower, you're bearish, you short it, and it gets shorted at the bid. So again, if you short at the bid, when you want to close the trade, you buy back at the ask. So let's focus on this again. If I'm bearish, the stock, I'll be shorting it at the bid. And as the price declines, goes lower, I'm making gains. And if I close it in those gains, it's a profit. Inverse, if I'm bullish, I buy it at the ask. And if the price goes higher, I have gains. And if I close it with gains, it's a profit. Again, now, because the stop stock spread is so tight, there's no variable, there's no distance between them other than 1 penny. So typically, as these prices move, they go correlate. Sometimes it'll be a penny more. It could be 2 penny wide. The point is, the ask is $12.95 right now. The bid is $12.94. During this video, if the price goes lower, they should both go lower by an average of penny and vice versa on the up. But again, that's what you like to see in a stock. The spread, that's what is called a spread between the bid and ask. You like to see a minimum of a penny. If it's wider, it's a disadvantage. So we'll get to maybe a few examples like that. But this is best. Best when it's 1 penny wide. Now we're going to go to the option chain. Again, this desktop trading platform. Trading platform. This one's called Thinkorswim. It's offered from the broker called Charles Schwab. So if you open an account with Charles Schwab, you also get this trading platform. You put it on your phone with the app. I have it on the desktop here. And I put the symbol up here for the stock I'm looking at. So now I'm going to open up the option chain. See the word option chain? All these are contracts in this option chain. Contracts. Remember I told you might have one that's 6 months. You might have one that's 12 months. Shoot, you might have one that's 1 year or longer. Remember I mentioned not all stocks have options. So on this platform, if they're weeklies, they're going to be here in the color with the word weeklies. And if they're different, they're not going to be that color. Give you an example of what weeklies are. Before there were weeklies, there were options that expired the third Friday of every month, unless there was a holiday. That changed not too long ago, where they offer options that expire in a shorter duration. Yep. So if you buy an option on a Monday, there's an opportunity for a contract to close that expires on a Friday. You could close before then. You don't have to wait. Like I said, you don't have to stay in till the contract expires if you don't want to. So this being said here on the left, these contracts, see this one that says 10 September? That expires on the 10th of September. Today is the 10th of September. And the 25 represents the year 2025. So we go all the way down on the bottom, closer to the bottom. See the ones for the year 2026, 2027. Yeah, those are far out. And you also notice there are several in the month of September. Ones expire on the 10th of September, 12th of September, 17th September, 19th September, 24th September. Yep, see, a lot of them. Go further out in October. There's ones that expire 3 October, 10 October, 17 October. And then again, here's December, 19 December. Expires 19 December, 2025. Now here, in this parenthesis, tells you how many days are left for that option. Again, 0. This first one expiring today. This other one, 2 days. 2 trading days, 7, 23. Let's go all the way to the January 2026. This one again expires on the 16th of January 2026, 128 days. So as the option gets closer to expiration, the days melt away. The days melt away. There are different exchanges that offer options. Just like there's different stock exchanges. I'm going to give you an example. Stock exchanges. This is the New York Stock Exchange and the NASDAQ Stock Exchange. There's more than two. I'm just giving the big ones. They compete against each other for business. Give an example. IBM is on the New York Stock Exchange. Microsoft is on the NASDAQ Stock Exchange. If you have a broker, you could trade on either one of those exchanges if you have a stockbroker. Not all stockbrokers offer options to be traded. If you have an account right now, and if you're verified, approved, where you could trade options, you could do these trades right now. I already gave you an example. The name of this broker is Charles Schwab. You could trade stocks, you could trade options, you could trade futures. Commodities are part of futures. So you could do the futures, the stocks, the options, fractional shares, and whatever else you want to know, you check on your own. So when I'm doing options, I typically, if I'm not doing weekly, if I'm doing a swing trade a little bit longer, well, even a weekly swing trade, but typically I'm looking for options that are nearest 45 days. So the nearest one to 45 days happens to be this one, 44. Right here, 24 October, expires 24 October, 44 days. Yesterday, this was labeled as 45, but a day melted away. That being said, I'm not so concerned if it's the weeklies or not. Less so. But I open this up. I'll open the contract up. Again, this is the contract. When you hear someone say contract, we're not talking about the strike. We're not talking about the price. The contract is when it expires, what year it is, what month, what day. 24 October, 2025, 44 days. So I opened up the contract. This is the option exchange of strikes for this contract again. These are all the contracts under the option chain. Option chain says right there. These are all the contracts. I'm going to open up the 24 October contract, and these are all the strikes. But there's more than that. Because see the number 8 strikes? I could do all. Yeah, a lot of them. I'm not concerned of all those. So I'm going to reduce this. I could do 14. I could type in my own. But I want to keep it right now to 8. So again, the stocks here, top left, 1293. Again, the price is moving because the market's open. Look at the bid and ask, 1292, 1293. It went lower, didn't it? Remember, wasn't it 1294? Yeah, it went lower. And look at the volume. The volume ticked up a little bit higher. There's two sides to this option chain. This side says the word calls. This side says the word puts. That's different than bid and ask. So the calls here, they have a bid and ask, and the puts have a bid and ask. All these financial instruments have a bid or ask, and I explained at the beginning the bid and ask. It's the same way on the options. Again, I mentioned at the beginning, you could go back and listen at the beginning, the bid and ask on the stock. It's the same bid and ask on the options, but it's more flexible here on the options. So the calls, you have call contracts, you have put contracts. Looking here on the contract for 24 October, and let's look at the one nearest the strike price. I mean, nearest the underlying. The underlining is UNG, and the stock is $12.91, $12.91.15, or $12.91.5. So we'll go down to the strikes. Here's the word strike. The nearest strike to that would be $13. Here's the 13. Let's go look at the calls on this side. Again, the word calls and the 13. Going to cue it in. There it is. So again, middle column strike, We have the open interest here, 50. So that means since this contract was created, whenever they created it, might have been created 3 weeks ago, 4 weeks ago, 5 weeks ago, might have been created 10 weeks ago. The point is, since they created it, this is how many contracts are open right now. So tonight, when the market closes, they'll update this for the next day. So today, see the column volume. Today, there's 17 contracts that traded. Yeah, this is a light volume for this underlining. So 17, some got bought, some got sold. So tomorrow morning, 9:30 a.m. when the market opens, this will be updated. It's either going to be higher or lower than 50, depending on how many of these were bought or sold. Yeah. So right now, if they were all bought and not closed today, then this would be updated to 67 and vice versa. So we'll find out more tomorrow. The column delta right there, 53. As the underlining moves right here, the price 1292, as this moves further up, further down, the strike delta changes. All right, let's go now here. Bid and ask. 85 cents, 90 cents. It's 5 cents wide. That's not good. Again, I showed you the stock. It's a penny wide here on the top. Under the level one, bid and ask, penny wide. I like to see options that have tight spreads too, 1 to 2 cents. I don't care really much. I definitely want the stock to be either 1 or 2 cents tight, not wider. But for me, with the options, the strategy, one of the strategies I'm going to show you, I didn't mind that it's wider. Okay, 5 cents wide on the call for the nearest strike to the underlining. Let's go look at the put. Here's the put. 84.90. So that's more than 5 cents wide. And the open interest, one contract. And today there were 2 traded. So this is going to get updated tomorrow. Open interest, it might be 3, it might be 1. Again, we don't know if these 2 were bought or sold. And these numbers would change between now and the close of today. And the delta, if you're interested in the delta, 47. Let's go look at strategies now. I'll show you. Let's cue this out. Delete. I have trades I put on today. 24 October, 44. I did a strategy which is bullish using the put options. Some people call it shorting puts. The way you communicate with a broker is you sell or open. Selling an option to open the position and collecting money as a credit. So I'm like the insurance agent. You're paying a debt to the insurance broker and they're receiving credit. So I sold the 12 put, again, 24 October contract, 12 puts. I sold it, the price at the bid. It was different earlier when I sold it. Yep, the bid was different and the ask was different. So I want to collect more money, so I put the price in at a higher bid. You could do that. I started off the bid at $49. Didn't get filled. Tried 47, didn't get filled. Tried 46, 45, didn't get filled. I put in 44, I got filled. So I have positions now, short put strikes, the 12 strike, again, the 24 contract, 24 October contract, short the 12 puts, and I collected $44. Yeah, it has a decimal. So if you don't know, options in the stock market represent 100 shares. Yep, I know it doesn't say that here. I'm telling you, that's how I'm representing them. If you study options, you'll learn that. If you study the correct places, you'll learn that. One single stock share is $12.92 right now. All these contracts, each of them represent 100 shares. They are derivatives. That's the key word, understand, derivatives. So when I sold the 12 puts, I got filled all my contracts at $44. That's good. I received $44. As this stock goes higher, tomorrow, the next day, maybe today, this will melt away. It will go lower. If this stock goes lower today, tomorrow, the next day, well, this will go higher. And then this will go higher. So because I sold put options, I needed a margin account. And I told you each contract represents 100 shares. So each contract, I had to have margin. So the strike is at $12. That's $1,200 I had to prove I had in my account for each contract. If I do the 11 strike, that's $1,100. Simple, 100 times each strike price. Well, why didn't I do the 11? It would have been less margin. Well, it's a lower price. I'm looking to collect at least $30 or more. I collected more than $30 per contract. I told you I collected 44. So this open interest tomorrow will change tomorrow morning. So if you notice right off the bat, open interest 21 and today's volume 31. So there's more trades that occurred today, open and closing. Some are open, some are closed. There's more volume today than there's even open interest. So maybe some people are following along with me and either closing positions, opening positions. And this changed between now and the end of the day, probably. And look at this one, 1250 strike. Open interest since the contract was created, 20. And today there was 100 trades. So somebody might have bought 1, 2, 5, 6, 10, 50, 70, who knows? Yeah. So that's one strategy I showed you. It's a bullish strategy, selling put options to collect income. And this one again, 44 days. Well, I may not stay in it till 44 days. Money management. I might be targeting half my price. Or maybe greater. So let's just say hypothetically, the stock goes higher by a few pennies and stays above there. And then this premium here, again, I tell you, these are premiums. If this melts away, because it will melt away, because I'm selling some things like ice cream. Remember, I told you time, just like the insurance agents. If you paid for a 6-month policy and now there's only 3 months left, well, you're only going to get a certain amount of money back, reduced the amount you paid in. But that's good for me because I'm selling it. And as the price declines on this short put, I'll buy it back at a lower price. And that's a gain. But because I'm closing position, it's a real profit. Got it? Yeah. Show you something else. Again, another contract I want to show you. The 10 October, 30 days, 30 days till it expires. I put these contracts on for 10 October. Back last month, I chose this contract 10 October. The strike I chose was the 12 put. I was bullish and I shorted puts, aka sold puts. I sold the 12 puts when the bid and ask were different than they are now. And that 12 puts I sold back then, I had received $60 per contract. And then when I sold them back, when I opened the position, I shorted the puts. Again, I sold the 12 puts, shorted them, collected $60. Again, the price was different, so I goosed it up and got filled at a better price. The price might have been like $57, but I wanted to get filled at a better price, and the spread was wide, so I moved it up. I moved it up to 60 and got filled. That's good. So again, you don't have to accept these prices here. You could put limit orders in. The point is, I sold a 12 put 60. And when I closed the position, I shorted it. Sold short, similar. So I sold to open, collected $60 per contract. And then this month I closed them. And when I closed them, again, I closed them at the ask. The ask was at $27. So again, the price was at 60 when I originally got in, and I closed out at 27. So the price was lower. That's gain. and it was a profit. That's the strategy of selling options, calls or puts. Again, I'm just showing an example on puts. This is one basic strategy. Many more I discuss, but I want to keep this video where it is on one strategy for options. Market's still open till 4 p.m. New York time. Not showing the charts, I'm showing the option strategies. If you're bullish, there's other strategies. So that's just one strategy I showed you. 24 October contract, 44 days. The 12 put, I'm bullish, so I sold puts. There's several other strategies. There'll be on other videos, but this is one of several bullish strategies. Thank you as always, spending just a little time with me. That's it for the video. Thank you for watching.